Good morning, traders and investors around the world. Welcome to the first day of March 1st edition of Pre-Market Prep with StockOdds. Joel Elconin, joined by Rob Friesen here on this choppy, volatile Tuesday morning, but that means opportunity if you're doing some spread and basket trading. Let's look at the futures. They're so hard to quote. They're moving so fast. Let's just call it down $13 at or $16 at 43.51. Crude getting closer to Rob's target, up 731 at 103.03. Gold, indication of inflation, up $22, 1922.70. Silver, it's going the same way, up 62 cents at 24.99. Bitcoin, stopping where it should, up 2,000 at 44,405. Ethereum futures, they're hanging in there. They're up $133 at 29.72.0. Rob, I'm going to stop the screen share here. I'm going to bring you here on this wild Tuesday morning, but I guess it's not that wild. I guess this is just the norm now, right? This is the way the market's going to be and forever, I guess.
Well, I mean, when your volatility is higher, you're going to have a greater degree of, inflection points, reversals. You're also going to have moves that are, bigger than the average. So you have to allow for the average, at plus or minus one standard deviation for sure on that, so that you just allow more room. So here's an example. In StockOdds, you can go to the single stock file and download that. We have all kinds of different data points inside that. So you have like 5-day ATR, 10-day, 20-day, 30-day, all the different breakdowns of time. So when you look at correlations, for example, you look at persistence of correlations. When you look at volatility metrics per instrument that you're trading, you look at what the norm is over the long sample versus what's happening recently. So obviously there's an expansion of the 5-day ATR over the 65-day ATR, right? There's an expansion. So when you add a standard deviation to that, that gives you that ability to allow for those bigger moves without getting kicked out, without, getting all bent out of shape, okay? So just remember, look at your short-term volatility versus your long-term. And if there's expanding, add a standard deviation to that, and that'll give you that wiggle room that you need. Okay. Second thing is, we can have we actually have an inside day on the SPY, not in terms of the overnight contract, right? Not in terms of the futures, but in terms of the day session. So Joel likes to look at the futures and look at the highs and lows and treat it all as one, and that's fine. But you also have to look at what is the limits on the day session, because remember, we're not just involved in the futures market. We've got the ETFs that track the futures, and so those price points are extremely important. So like yesterday, for example, how did we deal with the previous day's high? We had an inside day, but how did we deal with the previous day's high? How do we deal with, overnight lows, overnight highs? It's all relevant. So it's all of your numbers, not just one data point, right? Looking at the context, right? So today we have an inside day on the ETFs. Agreed?
On the ETF, yes. On the futures, no.
Correct.
But anyways, we'll go for the ETF.
Both are relevant, though. It's not one or the other. It's what is happening in the equity space and what is happening in the future. It's both are relevant. Okay,
I agree.
So we agree on that. So anyway, today is going to be high volatility, choppy. It could have been go back into last November, or even say July, August. You would have an inside day and the volatility was so low, like we were, say sub 18, even around close to 15, 16. So you get, it's really quiet and boring. So today is that kind of like choppy, whipsaw, moving a lot more just because volatility is elevated. So keep that in mind. More trading is required, allowing for more things important. Let's share my screen here and look at something.
Okay.
So, let's see here. Screen, this one. Tell me when you see it.
All right. Let me see.
So coming into today, in terms of sectors, there was something that was obvious. Now, we mentioned in one of these broadcasts that you can make money from the obvious, okay? The other thing is you can also lose money if you ignore the obvious.
Got your screen, Rob.
You got it?
Yep.
Yeah, so you can lose money if you ignore the obvious too, right? You can either make money from the obvious, and again, obvious means, you know, pretty much everybody knows, but you can make money from that, but you can also lose money from that if you ignore it. So today, what did we notice? Well, TLT was trading up, and financials, not only are they affected by that movement, but they're also affected by what's going on in the sanctions and banking arena and SWIFT and all that stuff. So there is loss of revenue. There can be even devaluation of assets if, like, for example, Citi is connected, you know, they have some exposure to Russia and stuff. And we don't know who else has exposure to Russia. I mean, you can go back to 1998 when I started with Bright and we had the long-term capital management stuff going on in July, August, and September, and the Feds cut interest rates in September of 1998 due to that whole shenanigan there. But that was again related to Russia. So we don't know if hedge funds have exposure. We don't know what all the systemic risk can be from this. Okay, there is going to be some. And one of them obviously is translating into oil prices or gold or, you know, flight to quality, whatever, things like that. But the obvious today was the move on the TLT and energy. So I was very happy to see that some of the people I'm dealing with StockOdds removed any shorts that might have been indicated for the energy sector statistically because of that macro, and also removed the longs on the financials, which are also exposed. So just keeping everything else fairly balanced, but not having long side exposure on financials or short side exposure on energy. That can make all the difference in your day. Okay. And you know, you're going to have to do that as a trader. You know, it's about adaptation, it's about sensitivity, the type of day. It's like, okay, what type of day is it? What's my response to this type of day? Remember the map of the market that we snapshot at the end of every day? We ask questions of that. Why is this group up? Why is this group down? Why are these stocks such outliers compared to the rest of the thing? You ask questions so that you can get back information, right? And then you can act the next day on that information if it's still valid. Well, the financials story yesterday and the energy story yesterday was intact, and that's followed through today, and it's intact. But what I want to show you why trading a spread relationship, and even if you don't trade it, just watching spreads
that can help.
So helpful. Okay. So on my screen is SPY versus XLF. Okay. So the fact that the spread is moving this way, SPY is my first symbol, XLF is my second symbol. So it's moving this way means that SPY is stronger than XLF. Okay. That was already indicated pre-market. We have a catalyst. We understand why. So it's not a difficult trade to take if you want to participate in that. Best thing is always go small and get a lot of practice before you do. But when you have a catalyst and you see an opportunity, then it's great. Now here's the thing. Had you bought this particular spread this morning, right? Say went long SPY and short XLF, even if you did it in equal, equal capital or even dollars, not adjusting for betas or volatility or anything like that, just simply dollars, long dollars versus short dollars. This would have been your experience, right? The spread has continued to move, and you say, well, that's hard to understand, ratio wise, because it's a very small change on the ratio chart. What would that be if it were like a differential? So then with a differential, you have to take that ratio. So let's just do 12. We'll round it up to 12. So it would be like this. It would be 12 times XLF. So you have to invert it, minus SPY. Okay. I'm trying to type here. Okay, so we'll add that. So that's the spread there. So that would be your short 1200 XLF and your long 100 SPY. Okay, so you can see the movement down, right? Now, that's not a difficult trend to be in and maintain if you are in a spread relationship, because it kind of gives you that buffer from that noise that gets under your skin, in the sense of, like you're in a trade, you're naked, you're sitting there just long the SPY, or you're sitting there just short the XLF. Just imagine that for a minute. And you're like, okay, well, I think it's done. Okay, and that noise really gets under your skin, and you don't maximize your trades. If you were in a spread relationship, you know that the first hour to 2 hours of the day are the best for relative strength. They're the best for separation of the haves versus the have-nots. They're the best for that flow of capital. And then we get, obviously, an opportunity for reversals, or it's expanded so much it's going to contract a little bit. So this may be the end of the move. But you see, we can put it on even the 5 minute if you prefer, just to see how smooth was that. We did have one stall out here, but it was still really early and no reason to really lock the profits. And then expanded down. Now I would say there's more of an argument to lock the profits. How much movement was that? So this was, it's 12 of XLF to 1 of SPY, or 1200 to 100, let's say. So that would have been $23 spread price down to 15. So you've almost made 10 points times 100. That's $1,000 trade just in that. So let me ask you, would it have been easier to make $1,000 naked the SPY? Well, let's have a look. Let's go to the SPY here and look at the 1 minute chart for today. So you would have gone long the SPY. How well would you have done making $1,000 long the SPY today? Joel?
Long the SPY?
Well, that's what, you think the SPY is going to be stronger than the XLF. How well would you have done? Okay, point made, right? Now let's take a look at XLF. 1200 short. Let's imagine that. Okay, that's a little bit easier, a little bit less noise. But look at the reversals that can happen to you when you're naked short. You don't have a hedge on. So initially popped up. That's a pretty violent move right there, which could catch you out. Same thing even here, this reversal that failed, but nonetheless. So much more difficult to have a naked position of, say, 1200 shares and stay in this all the way down to the bottom where we are now. But you go to the spread and you can see how much, we'll put it back to the 1 minute, how much easier it would have been to just stay. Because here's the thing, even right around here, there's no real panic. You're hedged to the market to a large degree. So yes, you're benefiting from the direction. Why the directional pick? Because of the argument that we have on the macro and the argument that we saw pre-market, which was the TLT move, the financials being weak, understand why. I'll want to short the XLF, but I don't want to be completely naked to the market. Okay, I'll buy the SPY against it. That's the beauty of spread trading. It allows you to get much more out of a trend.
Yep, great examples there today, Rob.
What's that?
I said great examples today. One thing that the moves and the counter moves and the shakeouts on this are just incredible. And if you have that spread relationship on, you can, not everything comes back in, but a lot of times it does. So one question here before we wrap things up today, coming from Eric M. So Rob, you use the factor-based differential spread when you enter a pairs trade to help you track price movement of the spread more easily.
What happens with the factor adjusted differential is it translates into pennies or cents of movement, which allows you to treat it more like the movement of a stock. When you just trade the ratio spread, it's percentage change, and it's harder to get your head around how much that actually is. So the way it works in a factor adjusted spread is the amount of, provided that you do it this way, you do the larger position on the first symbol. So it's something to 1 or something greater than 1 to 1. Then for every penny that the spread moves, it's that penny times your position size on the second symbol.
Okay.
So treat everything like something to 1, but something greater than 1 to 1. So you can do 1 to 1, 1.5 to 1, 2 to 1, 3 to 1, 4 to 1. Just remember, other than doing some of these ETFs, if you go into stocks and you go like, 10 to 1, it might be important to think about your bias. If I wanted a small cap that had maybe merger takeover potential, I would like that to be more of a concentrated position. And I would love it to be 10 of those to 1 of my hedge, right? Because if that merger comes through, you've got a nice core position there. You could really see some benefit, right? Or just when small caps really rip, it's really nice to have that relationship of small cap versus large cap, 20 shares to 1 share or 10 shares to 1 share. But just when you reverse it, you could have a problem if you got a short squeeze or whatever. Okay. So
okay. All right. We're going to wrap things up today. Down 33 handles at 43.35. Came close to that pre-market low. So 43.2250. That marks your pre-market low. We got to 43.26, trying to rebound. What you got for me, Rob?
Don't close it off yet. So the dollar is moving in the same direction as the commodities. Okay. Now think about that for a minute. If the commodities are rallying along with the dollar, that means they're overcoming that dollar influence. Normally it would be if the dollar moves down, commodity prices should rise, but they're moving in the same direction. So that's a flight to quality on the dollar, but the commodity strength is actually more than you see, believe it or not. The commodity strength is greater than what you actually see because of that relationship should be inverted, but they're tracking the same direction. Make sense?
Makes sense to me. All right. Pre-market prep with StockOdds, wrapping it up here on the first day of March. Everyone have a good day. Back with you tomorrow morning, same time, same place.